to call a vote?
Do we need to take a vote?
Yes, roll call vote. I mean,
We can barely hear you.
Vice Chair, we'll do a roll call vote. So Vice Chair Hill,
Aye.
Member Sleeth,
Yes.
Member Brickley,
Aye.
and Member Jane.
Aye.
All right. That was all in favor. Thank you. Congratulations, Chair Hill and Vice Chair Skolnick.
Thank you. Okay, number 3 on the agenda is review and discuss the PARS OPEB trust. And we have a
Correct. Thank you, Chair Hill. In this item, number 3, it's the review and discuss our PARS OPEB pre-funding trust program by our PARS administrator. And you've met him, Tanner Love, and also our PFM Asset Management Investment Funds, also, which is joined by Andrew Brown online. And this is just a review of our program of our OPEB retiree benefit expense from PARS trust account. And then review and if appropriate, make recommendation on the investment strategy. Just real quick, I want to give a background because I know there's 2 members on the committee, 2 new members. So the town of Atherton established an irrevocable trust to pre-fund other post-employment benefits, which is short for OPEB. So this provides retiree health benefit coverage for eligible retirees, employees for the town. So this is separate from the town's CalPERS defined benefit system. So OPEB benefits are separate and they cover medical expenses only that are incurred after retirement. Over the years, to manage that, we've used to manage our OPEB liability. We participate in PARS, Public Agency Retirement Services, for OPEB retiree costs. And over the years, the town has contributed significantly to the liability, reducing our liabilities to the trust. And as of 2023 in March, we began drawing down benefits and directly from the trust. So real quick, OPEB Trust is a team is supported by PARS, which is our trust administrator and consultant. They provide the record keeping and compliance. U.S. Bank is our fiduciary custodianship of the trust. They hold the assets. And PFM Asset Management is led by our portfolio manager, Andrew Brown. He's the investment advisor also to U.S. Bank and is responsible for managing our trust investment portfolio. So it's a collaborative approach on the team for our long-term commitment to our OPEB. You have the staff report before you, so without going further into the staff report, we've contributed $5.8 million to the trust, and as of last year, the trust had $8.66 million in it. Without further ado, we can return to the staff report before you, but I'd like to turn it over to Tanner Love, who will present the PARS portfolio for us, our program review, and then Andrew Brown will discuss our investment of the trust, and then we can further discuss further opportunities from the staff report. One being that if we currently are in the moderate index investment for the trust, and if appropriate, the committee could decide to change that investment option. Staff recommends that we do not, that the moderate passive approach is adequate for our OPEB needs right now. Without further ado, I'd like to turn it over to Tanner Love from PARS.
Great, thank you, Robert. Were you able to pull up the presentation maybe for the people
Yes.
online? Thank you.
Yes, I can do that.
Or Angela can also screen share as well.
I was going to pull that up. Let me do that right now. And then I will share. Yeah, thank you for that. Okay.
Great, thank you, Robert.
You're welcome.
So yes, I'm Tanner Love from PARS. Thank you for having us today. I love your town. I was driving around before the meeting, and it was great to be out here. So thank you for having me, and I'm glad to be here. And so the first slide we want to touch on, if we can go on to the next page, it's just the contact information of our team. Under the PARS column, you have myself at the bottom. You can always start with myself, and I can get you where you need to go, and we can get everything handled. And then you guys are probably very familiar with Jennifer Meza. She is the consultant for the town, but she's out on paternity leave. So we have Angela Tang on the call as well, filling in for her if you ever need anything. And then on the PFM asset management side, we have Andrew Brown on the call, and you guys will hear a lot from him later on during this discussion. If we go to the next slide, we're just going to do a little overview of the PARS 115 Trust team. So like Robert alluded to, this is a collaborative effort. So the first box is the blue box, that's PARS. That's who I myself and Angela Tang represent, PARS. We are the trust administrator of this plan and the consultant. So really serve as the record keeper, consultant, and the central point of contact for you. We'll monitor all plan compliance as well as process any contributions or disbursements that you would ever want to make. So PARS has been in business for over 41 years. We have 2,000 plus plans under administration, as well as over $9.2 billion of assets under administration. Robert did allude to this a little bit earlier. The trustee is US Bank. They are the 5th largest commercial bank and one of the nation's largest trustees for the Section 115 trust. And the US Bank is the one that safeguards all the plan assets. And then if we go to the next one, the investment manager is PFM Asset Management, and that's Andrew Brown represents on the call today, and he'll be doing the bulk of this meeting and going over your investment plan. And then if we can go to the next slide. Perfect. So this is just an illustration. We're diving into the Section 115. So currently you are utilizing pre-funding OPEB for retiree medical benefits. And currently right now we have assets sitting over just north of $8.8 million. And we also, if you ever wanted to pre-fund pension, always let us know. We can always start that conversation as well. But really with the 115 trust, it allows you the benefit to have sub-accounts, financial stability, as well as flexible investing. And then if we go to the next slide, we're really going to dive into the summary of the town's plan and your current account information. Perfect. So the plan effective date goes back to May 16th of 2012. The plan administrator is the city manager, George, and the current investment strategy right now is the Modern Index Passive Strategy. If we look down to the bottom half of the page, this is your account information as of May 31st of 2025. So let's look at the first line, which is the initial contribution, which was made back in June of 2013, just shy of $1.3 million. Additional contributions that have been made is just north of 8.1 million. Bringing us to total contributions to that May 31st number of just north of $9.4 million. Disbursements are just north of 4.6 million, leaving us with an account balance just north of that $8.8 million mark. If there's no questions on that, we can go to the next page. Perfect. So this is really just an illustration of all your history of your contributions, disbursements, and total assets as of that May 31st date. So here's a bar graph and a little illustrations there, but then if you go back to the chart, you can see the years that you've been in the plan all the way to today's date or the December 2025 of 5 months of activity. So you can see all your contributions, disbursements to that December date. And also the last column, you can see the evolution of those total assets, which brings you to that account balance of that $8.8 million, a little bit above. And then we can go to the next page where we're really just going to dive into the actuarial evaluation that I asked Robert for. So thank you for that. This was prepared by Precision Actuarial, dated December 16th of 2024. And the measurement date that was used was June 30th, 2024. So if we look at that measurement date of 2024, we have currently 41 actives. We have 40 retirees with a total of 81. So if we compare it to 2023, there's only that one difference there from one person retired. And then if we go to the next one, next page, it dives more into the actuarial report a little bit more in depth. So we're going to look at the measurement date of June 30th of 2024 column. I do want to note the discount rate for this column is 6.30%, So it did increase from the year prior. And then we're going to look at the total OPEB liability, which is just north of $8.1 million. The fiduciary net position is just north of 8.6 million, and the net OPEB liability is just north of $510,000, leaving us with a funded ratio of 106.3. So you guys are doing very well. So that's overfunded. And if we look to the assets as of May 31st, your funded ratio actually goes up to 108.3. And then the actuarial determined contribution is just shy of $120,000. And then the last column is the annual benefit payments, just shy of $470,000. Any questions so far? Yes, Stephen?
I'll have kind of basic questions. I have a bunch of them. This $510,000 is a surplus, right? And the plan is to use that. When that's used, is PARS the administrator, or do you actually have the math? You're making the payments for the retiree benefits, the money's coming into you, you're making payments for medical provisions for retirees? Is that what PARS is doing?
PARS, Angela, can you answer that question? I don't want to misspeak on this one.
Sure, not a problem. So PARS, as well as PFM Asset Management and US Bank, we take care of this 115 trust on behalf of the town. So it gives the town the ability to invest those funds with the hope of getting a greater rate of return rather than leaving it in the town's general funds. In regards to payment to the retirees, we can make those payments, but we will take the direction from the town. So the plan administrator or any authorized signer will be able to give us direction to pay those out to the retirees.
So PARS is the plan administrator also, when you just mentioned, so if I'm a retiree and I have a medical expense and it needs to get paid, does it come out of PARS?
And Robert, you may be able to answer this, more directly.
No, thank you, Angela. Yes, correct. So because of this 115 trust, the retirees, when they retire from the town, they retire through CalPERS, and CalPERS is CalPERS Health. So as a retiree, you have to be retired through CalPERS Health. So CalPERS manages the retiree health, and they bill the town every month for the retirees that receive retiree benefits, retiree health benefits. And in doing so, what we do is we send that over to PARS, and we say, here's the list of our retiree benefits. This is retiree health, medical health retirees that receive these benefits. And every month they will wire direct deposit that monthly medical reimbursement to the retiree. So we work in tandem with CalPERS to pay the retiree health. And in addition, we make the retiree whole through PARS. So PARS pays them directly.
Retirees,
Right.
Yeah.
pension check, health insurance deducted,
Correct.
Right.
reimbursed via.
Correct.
Steve?
I just have a clarification.
There's an accounting that's done to you by PARS that says beginning balance, additional contributions, distributions, demands that are made.
Correct.
Ending balance. And the distributions that are going out are largely funding that's going over to CalPERS, where they're making a demand for payment for services that were provided in the previous month or something like that.
Correct. Well, because retirees get their retiree health through CalPERS, and as George mentioned, that gets deducted from their retiree pension check. So if their health is $1,000, that gets deducted from the retiree health, their pension. And in turn, because they receive that benefit from the town, we take what the medical benefit is for that month, whatever that monthly bill is, and we tell PARS, please reimburse $800 to this retiree and take it out of our trust.
So then the
And they do.
demand is made through US Bank as the trustee for PFM to liquidate assets in order to be able to make payment.
Well, the US Bank, PARS has, because they're the administrator, they have access to submit that to US Bank to take that out of our trustee account. But they get that authorization through us. And we say, disseminate these payments to these retirees from our trust account, and they pay it, they take it out. of
A
it.
trust document that controls who's responsible for what, that says US Bank is the trustee.
Right.
They have certain responsibilities, but this trust, we still retain seems like we still retain a lot of powers.
We maintain the trust. Yes, correct. We maintain the powers of how we use the trust.
For example, we could say, hey, we want to use 500,000 this year, and they're going to observe our wishes, no matter what Precision Actuarial says, no matter what PFM says or PARS says.
What,
Correct, but we can't say, just give us $500,000. It has to go towards retiree health benefits. And that's what we're using it for.
Got it.
And we send it to them every month. So what we try to do is, because retirees get paid monthly, so because their health bill gets deducted from their pension, we make sure that we send this information to PARS. That way, when that is deducted from their pension, they're getting back that health benefit. They're getting reimbursed.
Okay.
And we have to use this trust to do that, the 115 trust, because it's tax exempt. Yes.
I just really point clarification. I think it's your watch, but somehow these are really high. It's a dollar for dollar. And so whatever your health care bill is, I mean, you've got cancer and you're going to go in for, and it's tens of thousands of dollars, right? Or $100,000s of dollars. It's a dollar for dollar.
But we don't bear all that responsibility because they've already paid premiums. Somebody's already paid premiums into CalPERS to do it. CalPERS is either the initial insurer or the reinsurer at some point. Don't we work within a band, right? Where if we're funding $500,000 for a liability for 40 people roughly, their expenses are going to be in excess of that. So we must be restricted, huh? I mean, this would be millions going out. So that band, that's something that CalPERS watches, that PARS watches to make sure that we're not paying anything that we shouldn't pay.
and Steve, you asked at the very beginning, what happens when the 510,000 is used up? Well, ideally, it won't be used up. The total liability is a discounted value. And so if our investments continue to earn 6.3%, then we're always going to be in a surplus
Yeah, it's been the
position.
trend I noticed in the last couple of years. That's a recent event, huh?
Oh, Bob, sorry.
Bulk of this reimbursement, these are traditional insurance policies that CalPERS negotiates with insurers. The bulk of the money is going to pay insurance premiums, which pay the actual medical expenses whether it's cancer or health. My only question is about things like deductibles. Do we have to reimburse them, and how do they make that?
That's strictly, the deductibles are strictly on the retiree themselves. We just pay that insurance. That's all it is.
Is what Bob's saying, is that what gives us the predictability of this thing? So that we can go, insurance premiums are never predictable, but maybe there's a trend. Is that what gives us a little more certainty about, hey, 8.8 million is enough because our demand's going to be $500,000. It's not going to be 900,000 and it's not going to be 200 because the actuary is able to come in and see typical premiums are in that range. Is that?
The actuaries, every couple of years, actuary reevaluates that, the mortality, the rates of the insurance, all of that gets calculated into the actuarial report, which could either increase the liability over time or decrease the liability. And then the opposite side of it is that our net position continues to grow. I think that's where it's benefited us, is not only has our liability it increased a little bit from 23 to 24, but that's just the the assumption changes in the healthcare rate trends, but the net position has benefited because of the investment of the trust. So that's helped us a lot. Like I said, we started with 5.8 million that we allocated to the trust, and just 2 years ago, we decided to start using the trust to pay this 480 to 525,000 in medical expense.
And just for some additional lack of clarity, PARs and PERS, they're totally separate. They have nothing to do with each other. So the Section 115 plan that the town set up allows the town to pre-fund its commitment to past retirees for retiree healthcare and refund its current staff going forward.
Correct.
To allow them to retire from CalPERS healthcare system, but not pay the premiums. The town's got a much smaller cost for retirees than it does for past retirees because we closed that program.
So I'm gathering that am I overstaying my welcome with these questions?
Yeah, of course.
So I gather the reason why one of the reasons it was established was because besides wanting to quantify liability for these retirees was to set up a separate trust so that you could actually use investment results to gain that. It seems like it's a primary driver. Because otherwise I'm wondering, well, why don't we just stick it in a fund on the side and invest it? But the answer to that is we can't, right? You can't take $8 million and stick it in a fund within the town of Atherton and hire PFM and do the work. You follow?
You could, but it wouldn't be untouchable. The 115 plan.
Got it.
And because it's a 115 trust, it's not taxable to the retiree. If we didn't have the 115 trust,
Yeah, that'd be horrific.
then it would be the retiree
Okay.
get taxed on it. So this is what allows us to fulfill our obligations going
The
forward.
last one for me is, for now, is this actually determined, this ADC, I don't mean to say this, almost seems like a not useful number. 120,000, it's like, well, we're 700,000 over when you look at these periods. We're going to use maybe 500,000. Why do I care about normal costs and on amortized unfunded actual liabilities when we kind of got enough? I know what the demand on the portfolio is going to be. And is it for you guys to go, hey, if we kind of run out of dough, there's a reason for it because you should have put the 120 in?
Correct. Yes, and the 120 is basically, let's say let's say it wasn't an asset, we were negative $1 million.
Right.
That 120 is just we would fund every year for that future normal cost, what we would pay into it. But because we have an asset, that 120, we do not have to pay that.
So when PFM does its asset management and they get a rate of return that's in excess of whatever the carry costs are, then it's nice because then we don't care, well, we care, but we don't care so much about making a contribution.
Correct. That's just saying that's what our ADC would be without us having a net LPEB
Got it.
positive. Let's say if it was
It's a classic
zero-
retirees,
Correct.
hey, I want to retire, I need to put money away, how much do I need to put money away every year for that, or
The minimum.
college, or whatever? So we need to
Correct.
put it away in order to meet this obligation. What is
For the
that?
future.
Well, guess what? We're already, grandma already gave me a bunch of money and I don't need to do that.
Correct. Correct. And then we will continue to reevaluate this. I mean, who knows? The investments have done so well and our liabilities have been moderate as far as increasing. But if that ever reversed, that would say then we'd have to make this minimum payment, this 120. But
PFM won't let that happen.
right, they won't. And we've done well. I think we're probably one of the top up there in their clients as far as how we're doing.
Yes,
And using the trust already. When we last envisioned this back in 2013, we didn't envision using this trust for way down the road, 20 years from,
Yeah.
maybe in 2033 we envisioned it. Well, we started using it in 2023. And so it's kudos to the council that they set a baseline contribution. We contributed that. And then we just did well on the investment side.
Is CalPERS just take it or leave it? Whatever they bill us, say, that's it. Yeah.
Exactly.
Sorry.
Robert.
Thank you.
And then no more questions. We go to the next one. And this is just an illustration of your total returns for your OPEB plan as of that May 31st date. So you can see your historical returns all the way back from that June 13th date, all the way to December 2025, which reflects 5 months of activity on the year. And right now we're looking at 2.73% for returns, and then an inception to date percentage of 5.93%. And then with that being said, I'm going to pass it to Andrew Brown, and he's really going to dive into the investment side for you guys.
Angela, are you driving?
I am. Robert.
Oh,
I'm
okay. Robert, go back to the last investment page. Steve and Suzanne, welcome to the committee. A little birdie told me, Steve, that you're from the investment community. And it looks like you're pretty detail oriented. I wanted to give you maybe kind of a heads up in terms of this page and the investment management page that I'll be presenting in a couple minutes. No, go back. Perfect. Stay there. Yeah. Thanks, Robert. So what PARS has done here is they've calculated the town of Atherton's individual performance, and they presented it here based on your fiscal year periods, which looks like it dovetails with calendar year periods. And then so to the question of, well, how did Atherton do? Well, this would be the performance for the town. The performance that I am going to show you is actually for the pool that you're invested in. So if you have already kind of gone back and forth and looked at these numbers and the other numbers and said, something doesn't look exactly footing, that is why. So just trying to get ahead of that in case you've already done the compare and contrast. They're obviously going to be pretty close, but this is the town's performance as calculated by PARS. So, all
Can I
right.
just interject here?
Please.
Sorry. You indicated that it looks like that the town's fiscal year is a calendar year. It is not. It's June to July.
Oh,
So how would that make your interpretation of this any different?
well, my interpretation of that was I saw the December ending period. So typically I've seen this presentation slide correspond with the underlying agency's fiscal year. And well, yeah, most California agencies end on June 30th. So I incorrectly made that assumption. So my bad there. Okay. So Suzanne, Stephen, typically in my updates, sometimes I hit the economic outlook pretty hard. Sometimes I go kind of quickly. Obviously, a whole lot of stuff going on in the world. Robert, can you go to my first heat map page? I think it's going to be page number 2.8. One more page. Several more pages. 2.8 in the bottom right-hand corner. Yep, there we go. Bingo. Thanks. Yeah, and so last year when I presented to the finance committee, I think this was the first time that maybe I had shown this heat map to you, which what it does is it presents 9 economic and market variables, and in a color-coded format, we try to portray how we feel about a certain dynamic out there. And so you'll see a black dot in one of the color-coded regions. Yellow refers to neutral. Orange, red would be some type of negative viewpoint to some dynamic. And green would be a positive outlook to something in the horizon. If you look in the upper right-hand corner, you will see for the period ending March 31st, 2025. So we have yet to revise this exhibit for the June 30th ending period. So I certainly do want to touch upon this. But since we haven't officially, as a firm, revised our views on these 9 dynamics, I'm sort of swimming outside of my swim lane if I'm speaking for the firm. But that being said, I am on the investment committee, and I am 1/8 of the decision-making voting membership. So I can kind of nudge maybe a little bit the lane line and just kind of give you a quick little update in terms of how we're looking at things. If you look at the first 2 rows and you see yellow, neutral outlook, towards what? Monetary policy, economic growth, inflation, labor markets, consumer spending, and financial conditions. And I'll just put it this way. Over the last 2 months, I have found myself in these meetings having to defend myself, or at least feeling like I had to defend myself and or my firm in terms of a neutral stance on these dynamics. And I think that much of it really stems from just the malaise and maybe the negative sentiment, what people refer to as soft data. So it's sentiment and survey respondents, either in the business community for business sentiment or certainly individual consumers and how they feel about things. If you sort of take those readings, a lot of the readings are negative, down in the dumps, so to speak. But if you look at the actual economic data, it isn't so bad. It isn't all that awful. And so that's where maybe the dynamic of, the difference between the soft data, what people say in surveys and how maybe they feel, and then maybe the hard data in terms of actual behaviors that both consumers and businesses are portraying. Over the last, call it 3 months, we have maybe been a little bit on the fence, obviously, taking the neutral stance. As I said, we've not yet updated these variables as of the end of the second quarter, as of the end of June. But just kind of offering up some quick anecdotes. Labor markets, unemployment still 4.1%. So I doubt that we would be tempted to move that to the negative outlook. Consumer spending, I think we would still probably keep it in the yellow, although 2 out of the last 3 months that we've seen for retail sales have had a slight negative associated with them. So we'll probably keep it yellow, but maybe with a temptation of moving it to the orange. Inflation still looks pretty under control. Monetary policy, I think that the Fed is still looking at possibly, if you look at the Fed funds futures, still looking for maybe 2 cuts there. So keeping it yellow or maybe moving it to the green, that certainly might be something that we might venture into. So much of this, though, really comes down to the bottom right-hand panel: policy, political, and policy risks. Frankly speaking, the ultimate level of tariffs and the duration and what countries get applied, what tariff levels, it's still pretty much up in the air. And I just look at not necessarily the ticker, but the news wire, and in any one day you can see 2 or 3 new Truth Social posts from President Trump indicating that this country is going to get this tariff and this sector is going to get this tariff. That it really kind of keeps it up in the air. And I would love to come to a meeting in the very near future and show maybe more of a take, right? Because I know usually the options in this world are buy, sell, and hold, but hold kind of feels like a scapegoat. And I'm in my DNA, I'm much more of a buy or a sell person. But for now, we are taking a wait and see approach, and at least in terms of our worldview as it pertains to these 9 variables. Robert, could you go to the next page, please? We started the quarter with this neutral outlook, if you will, also as it reflected in our asset allocation. However, call it about the 3rd week in April, we moved to a slight underweight position to domestic equities as well as international equities. And so right now in this exhibit, once again, in the upper right-hand corner, it portrays a March 31st end of last quarter positioning. In about the 3rd week in April, we went to call it a 1.5% underweight to domestic equities and roughly about a 1% underweight to international equities. So if we were to sort of revise this exhibit intra-quarter, we would have moved the yellow dots in the first 2 rows to the left-hand side slightly with respect to domestic equities and international equities. And we did that due to, at least in our minds, the preponderance of potential negative outcomes with so many of the policy issues that we were facing in April. And I'm sure, Steve, you're already kind of doing the mental math and thinking, well, geez, it would have been better had we had not made those small, slight little tweaks. Because really, after call it the ninth day in April, equity markets believed that the worst was in the rearview mirror once that the tariffs were merely suspended or delayed until July 9th, which is tomorrow. And the markets had a really nice rally for the remaining part of the second quarter, both domestic equities and international equities. But I didn't want to duck it, and I certainly wanted to share with you our slight underweight to equities to give you an update as to where we ended the second quarter of the calendar year in the final quarter of your fiscal year. The underweight to equities, then domestic equities, international equities, was then the counter to that was a slight overweight to the fixed income portion of the portfolio. So that covers a little bit on our worldview, and it certainly updates you in terms of our current positioning. Before we look into the numbers, is there anything I can answer with respect to any of our outlook?
So the town picks a pool, and it picks, I forget the name, moderate, passive, plus, right?
Yep.
So when we pick that pool, the bands that are in there that you work within, they're not through any investment policy statement of ours. They're your bands. We look at how much in large cap, mid cap, small bonds, whatever, and you have certain constraints that you may wish to work within. We don't influence those.
Everything you said is correct. The bands are 40 to 60% equities, 40 to 60% fixed income. Long-term strategic policy points would be 50% equity, 45% fixed income, and 5% in cash, which we'll use this as money market. You do not influence the tactical positioning, but Robert mentioned it twice in his opening comments. If the town felt that, well, okay, this 50-50, if you will, allocation does not dovetail with our goals, objectives, and risk tolerance positioning or desires, we wish to take more risk. We wish to take less risk. You certainly do control that decision. And if those were things that you wanted to discuss, we would
is it moving to the next one of the 5 portfolios? Is that what it is? Or within our existing portfolio, you'll increase equity exposure?
You would move to a different investment objective, a different policy portfolio.
That's tough nut to crack with the way that it's performed and how it's matching up with the outgo, though.
It's a tough nut to crack additionally, or more so, because the other 2 portfolios that maybe dovetail the moderate portfolio, one would be moderately conservative, which is designed to target a 30-70 allocation, 30% equity, 70% bonds. And then there's the balanced portfolio, which would be 60-40. That would be long-term strategic positioning. You know, it's not so much bang for your buck in terms of incremental gain, incremental risk. And probably 30-70 would be a little bit too conservative based on a 6.3% target discount rate. So, you know, I don't want to give the cheesy analogy of Goldilocks, hey, it's just right. But, you know, really, I was discussing this with Robert the other day. Based on the actuarial valuation, I certainly was not going to come into today's meeting and say, boy, I really think you should downshift risk, or certainly, hey, I think you really need to take more risk here. No, I think it's positioned fairly well for the goals and objectives of trying to attain 6.3, for the notion of you are taking a draw, 4 or 5%. So we do need to grow it. I think moderate still meets goals and objectives.
Our own asset allocations, and because this is really for retiree benefits for medical care. So there is a element of capital preservation in this thing. We can't extend out too far.
I'm gonna give you a little nod like this,
Responsibility
yeah.
falls on the town, right? If we move the allocation up, what you're actually asking, what you're doing is you're telling the town, we're going to move your equity exposure up because we think you're going to make more money. And if we think you're going to make more money, it's going to create a better overfunded situation so that the town won't have to contribute any money. But if that falls, then maybe during a short period, it's okay. But if there's an extended decline in the market, then the town is going to have to pick up the responsibility for this actuarially determined contribution, because the actuary is going to come in and go, nice call, guys, but your account's short, right? So when you start to extend risk out in this plan, aren't you, you're just asking the town to take on that responsibility if it doesn't work, right?
Well, Robert, if you're taking the minutes for this meeting, just let the minutes reflect that Andrew Brown and Steve are saying pretty much the same thing. In other words, I'm not saying to take more risk. Yes.
Correct.
But one thing to keep in mind is this is a closed pool. So the retirees that are actually getting a healthcare premium of $800,000 or more a month is dwindling. And even as our staff continues, the amount that they're going to be paid is only the PEMCA minimum, which is about 115 right now, $100 per month.
Right.
Retirees. So the
But an actuary takes that into consideration. I mean, they've got a zero date at some point. So they think that 8.1 million is the 6/30/24 is the adequate liability.
George, isn't it also true that if this trust ends in a surplus, we don't get it back?
That's a good question.
I'll jump
You
in
would
here.
continue for the PEMCA minimum for retirees.
And I just wanted to jump in real quick regarding the question if there's a surplus. So say when the day comes that all retirees have since passed and there are no additional benefit that needs to be paid out to any individual within the plan that the town has guaranteed benefits to. If there is an excess left in the 115 trust, ultimately that money will and can be reverted back to the town's general fund. And at that point, since it has addressed what it was intended to do, that excess fund is now back to the town and you can do with it however you wish.
Great, thank you.
Is
Yeah,
that
of
what
course.
the trust document says, that it goes back to the town?
Yeah, so it is an irrevocable trust. So as long as it is addressing what it was put in place to do, any leftovers will be reverted back to the town. And if that's documentation that or the committee wants to take a look at, we can certainly forward that to Robert, and he can share with the group.
We have a question.
Tom, through the chair, may I?
I'm sorry.
Okay, I just have a question. I just wanted to clarify, our pool of retirees, both active and retired, totals about 80 to 81. How is that number trending? Is it trending up or is it trending down? Because we have a small group of retirees, or how many retirees are we talking about?
So there's retirees, as was mentioned, Steve, that actually get a healthcare premium that are paid via the trust. And then there are active employees that when they retire, they will, if they retire from the town, they will receive the PEMCA minimum and also paid by the trust. But they have to retire from the town.
I just want to clarify, George, that on page 7 of this report, there is a total for 2023 of 80, 2024 of 81. What is that trend? Is it continuing to increase, or is it hovered around that 80 person number? It's not like we're San Jose that has 60,000 retirees, to take care of, or something like that. So I think we need to keep that in perspective also. But
It's almost like you should have another column instead of active retirees. You should have might be active
future,
retiree.
potential future,
Right.
or maybe we could go back and say, well, what has the trend been? Has it always hovered around that 80 number, both?
It- It's been around that number, probably plus or minus, 85.
Okay.
But
Your retiree number is probably going to go down, your active number is likely to stay up.
correct.
Okay, so
George, can you please
ultimately
get
it's going
closer
down.
to a mic? We can't hear George.
Awesome.
Sure. To repeat that, I was going to say that your retiree number will probably trend downward, and your active employee will stay about the same.
So it's going to trend down overall. But it doesn't mean that we shouldn't make good, sound investment decisions, every day. And I agree with you, Stephen, that I feel a little uncomfortable that a lot of this is out of our hands, but I think it would be very, very difficult for the town to manage it themselves, and play the stock market. That's why,
I mean, the way I see it with the trust and this 115 and the lack of taxability, you have an administrator, you have an asset manager, you have a trustee that's in charge of the whole thing. It seems like a wonderful way to run it, to be honest.
I'm sorry, wonderful what?
Wonderful way to run it.
Yes.
Because you got to have accountability
Right.
and, right.
Once again, Robert, if you're taking minutes, please make sure that gets in the minutes.
Yeah, I
Hey.
am. It's a good meeting.
Good deal.
let the minutes show that.
Hey,
Great, don't worry,
quickly,
I still got more
Robert, can I have you go
questions.
to page 3.1? Once again, I mean, Angela updated and Tanner updated the numbers through May on that investment exhibit. And yeah, my pool numbers are only through March 31st. But I did want to share this with all committee members, but especially the newer members, just to sort of introduce the concept of how we build the portfolio. I shared with you a second ago that our equity bands are between 40 and 60%. The fixed income bands are also between 40 and 60%. That second column over from the left, titled allocation, that shows what the allocation was as of the end of March. So you can see domestic equity, international equity. The other growth category refers to both domestic real estate, but also global infrastructure. And then there's fixed income and cash. So you can see the allocation as of the end of the March ending period. The calendar year segments are presented there at the top of the page. But more so in column one, the investment strategy is what we refer to as the moderate index plus strategy. The index reference there just refers to how we build this portfolio. With the exception of the money market fund, every investment in the portfolio is index based. We do offer a strategy known as strategic blend, where we have both active and passive investment options that we build a portfolio based on. But going back to day one, the town has been pretty adamant that they wanted us to build a portfolio using index-based strategies, and that's exactly what we have done. So Suzanne and Steve, I just wanted to make sure that you were aware of that. And yeah, like I said, this is March 31st performance ending period for the pool. PARS has it through May, so I wasn't planning on digging too deeply through these numbers since PARS is a little bit more up to date. So I just wanted to offer that up. This was the last exhibit that I was planning to share. So I'll pause to see if there's any investment questions or anything that maybe we went over too quickly.
I have some. On cash, we keep 2%. Do we need to?
Do we need to?
160 grand?
Well, I will say this.
Is it all in that U.S. obligation? I mean, is it in the money market?
It's all in the money market.
Okay.
And if you were on the committee from day one, I think that would have been a legitimate question to ask any time before 2023, 2024, I mean, for the longest period of time, as you know, cash earned nothing. And so anything that was in cash for call it the first 8, 9, 10 years of plant existence was just collecting dust. You know, now with money market at 4.4%, I'm not so bashful and ashamed, and I can look you into the Zoom eye and actually say, yes, we have 2% in cash. You know, getting 4.4%. The cash flow that comes off the intermediate term fixed income is about 4.6%, so that's a bit higher. But yeah, I think we are comfortable with the 2% cash allocation today. But I'll certainly offer up the anecdote that anything that was in cash before the Fed hiked interest rates, I would like to mulligan on that one.
When you guys go look down your funds, Fidelity Total, MSCI, Vanguard, REIT, S&P, do you do an analysis for replacement every once in a while of another index-based fund? Fidelity's got a zero-based, zero expense ratio fund. Is that
We definitely look at the fees. I mean, we look at the fees and the tracking error to the underlying benchmark that we go up against. I will share with you that typically it is a fee-driven exercise, but yeah, I mean we're cognizant on tracking error. Schwab has a lineup of funds that we get tempted to use every now and then, and sometimes we do use it. But yes, we do look at replacing the index options.
Is that Fidelity Total Market Index Fund? Is that these? Do you have access to that that fund that has zero expense ratio?
I got to check. I think that this has a two BIP. It's either 1 or 2. I'll double check.
Yeah. That'd be my only thing in looking down this is just, it's not so much, it's partly, are you using the least expensive fund that's out there, but it's what's your process to replace those. So do you have your normal course of business, do you look at all your portfolios and go, listen, we've been using Fidelity Total Market Index, but like you said, Schwab's got some product. We noticed that it tracks the underlying index close to exactly, and we're going to save a couple of basis points on it. Is that something you do?
Our public market research team does that. I think it's maybe a little bit more readily of an exercise for the actively managed funds to make sure that we've captured the lowest expense ratio class within any one particular family. And then, of course, I mean, we're obviously doing strategic reviews of the managers to making sure that they're above the median and ahead of their passive benchmark targets. But it is an exercise that the same manager research group does on index-related options. I'm just not sure of the frequency there.
Okay. The last thing on this one is in the gray bars where you've got the funds that we have. Over on the right-hand side, you got inception date. Then you have 1, 3, 5 year, 7 year, 10 year. Am I right in assuming that we didn't actually get the 3, 5, 7, 10 year? We've got the 11, 1, and 24 and on for Fidelity Total Market. So we can't say that our Russell 3000 index equivalent over the last 10 years has done 11.74. That's what Fidelity did, and we didn't own Fidelity prior to 11/1/24.
That's correct. And in fact, in looking at the columns, the only thing that you could point to would be year to date and quarter, because 11/24 wouldn't have captured the 1 year.
That performance, were we always index based for 10 years, or was that a change that occurred some point along?
You've been indexed from day one.
So that comparison somewhere where our actual return is compared to the index before fees, that's somewhere else here, right? How did we?
Angela and Tanner, did you?
10 years compared to the index in our actual fund.
I think you're having fun now. But these are really good questions.
I'll prompt it by saying, you know, on that when you're index based, you're index based. So unless there's an expense inside the fund, you own the S&P 500. So an investment advisor coming to you and saying, guess what, I did what the S&P 500 did, minus whatever the expense ratio, that should be pretty much what it is. So it's not a big exercise, in my view, to run a moderate index-based benchmarked portfolio. It's almost automatic. He's obviously doing tactical, but it should run itself. I'm probably putting words you wouldn't like to hear, but it should run itself at some point almost.
I've heard it from the town before, so yeah. And of course, as you say, I mean, when you do tactical, it'd be nice to get it right. And obviously, in the third week in April, we did not. But yeah, I mean, for the most part, you're going to see the underlying index funds should be pretty close to the underlying benchmark. I think in global infrastructure, there may be more deviation. I believe that the iShares Global Infrastructure ETF officially does not go up against the S&P Global Infrastructure. So sometimes in those, I don't want to say less efficient, but less followed markets, maybe there'll be some delta.
I'd like to, next round, I'd like to see that is not, hey, we changed our funds in 24. Here's how they did over 10 years when we didn't own it for 10 years. It'd be nice to see this year to date, 1 year, 3 year, 5 year, 7 year, 10 years since inception with our actual fund in there compared to the index.
Well, you do see it. It's so the portfolio top line item that would be the pool, and then the blended benchmark would be the underlying target. So if you compare the top line and the second row, that would be I think what you're describing, Steve.
So you show it in bulk. You do the blended benchmark.
Well, yeah, you showed it at the bottom line. Yeah,
that 568 compared to so our spread is on since inception is it's basically the expense ratio probably, right?
Basically. Yep. Hey, I have to go. I have the city of Livermore. Everybody has buzzed in on the city of Livermore's 3 o'clock call. Is there anything though I can answer before I have to go?
One last question.
Please.
The information that was updated through May 31st, example page 9. That's the pool that we're a portion of, not our individual plan, or is it our individual? That's our plan. So what you're asking about is you want those numbers on page 9 compared to certain funded indexes?
Exactly.
If nobody has anything else, I have one last thing. So, as Robert and George and Tom knows, I'm big on paper. I have files on budgets. I have numerous files on pensions. I have files on all kinds of things, property taxes, etc. Back when we did the last OPEB refresh, I threw away all my files on OPEB. They no longer serve any purpose. In my lifetime, we'll never make another ABC. The reason isn't because of the low surplus that we have now, but it's because of the way they calculate our liability. Some of you will remember this possibly. Changed the accounting standard 6 or 7 years ago. And now include an explicit and an implicit liability. The explicit is what we'll probably pay. And actuaries are accurate. Long haul, they tend to be pretty accurate. The implicit, fictitious number, many people in the accounting industry have said shouldn't exist, but it still exists. In our plan right now, it's about $1.6 million. In theory, we can add that to our surplus. We have not $500,000 surplus or whatever. We have another $1.6 million. Barring some kind of disaster that I can't fathom, we have no reason to fund that implicit number. We we should never have to make another contribution.
Do you want to explain why, what the implicit number represents?
It's an estimate of how much our costs would increase. We could not buy health insurance through CalPERS at their incredible race with incredible sized population, and instead had to go out and buy that coverage on our own, buy a group plan. And we wouldn't do very well because we have a lot of elderly employees. So our costs would go way up. But the chance of CalPERS not being in that business, or the chance of us not contracting with CalPERS for advantageous rate, I presume is as close to zero as anything could be. So I just don't see that we'll ever make another contribution to OPEB, certainly not in my lifetime.
Excuse me. So you're recommending that we don't make that 120,000 contribution on
Absolutely
this?
not. And if you look, we haven't made it the last few years. And the contributions before that, we were making the ADC, but we were also, procedure was, we'd put the money into the trust and the trust would pay the insurance premium, back, reimburse the employees. So the bulk of that extra money beyond the funding we did to start this thing with $5 million was passed through, put it in one hand and take it out. So we haven't made any contributions in the last couple of years, and I don't think we will.
And that's the staff recommendation too, right?
Correct, it is. That,
And when I read through it, looking at, I mentioned this before, I didn't find where I could, where's 125.25? Where's $120,000 fit into this whole thing? It just wasn't a useful number for me. So I don't see funding it either.
It's an actuarial calculation of what, like they do with pensions,
Yeah,
less complicated. It's the amount of the liability increase for that given year. That's what should be put in to fund
the future.
the earned benefits for that year.
I would say that even if the overfunding, even if the surplus was $2 million, they're still going to tell you that it's 125.25, right? It's a black box decision outside of the assets.
I have a general question, Tom. Sure. I am very curious on page 3.3. What is the purpose of all that and how am I supposed to use that information?
What was that? Sorry.
Page 3.3 at the end.
Mhm.
What's the purpose of that and how am I supposed to use this in terms of our discussion today?
This was an update on, basically on how the allocation was on the historical parts of how PARS was using. You can see 1986 to 2007, it's just the benchmarks, the weights of the allocations strategy yeah, it was just information purposes. It's not to make a decision, it's just showing you the allocation purposes.
How it's changed.
Correct.
I mean, to me, what it said was when I look at the April 27 and maybe prior, even have this in April 27, 2007, it made me understand that we're heavy, S&P 500. And I just thought, okay, we changed our mind in October, or we changed portfolios in October 12. So that may be why there's a difference. It's for me, it was a philosophy change.
Correct. I mean, correct, because PARS has been around for a while. But yeah, you can see from 2007 to 2012 what the different indexes that have been added. Correct.
Robert, should the committee make a recommendation both to whether or not to make any contribution and whether or not to continue to follow the moderate
Yes,
allocation.
if correct. If the staff report illustrates that staff says, recommends that we do not make an ADC payment, and we do not anticipate to make one in the foreseeable future through Bob's lifetime. And as he keeps saying, and also the recommendation, if appropriate, would be the committee could change the asset allocation. But again, this would be the recommendation, and it would go to the council if we decided to change the investment strategy. Staff agrees with the moderate passive index that we're using. You can see what it has done for us in the last 12 plus years.
So should we make a motion and a vote? Okay.
Correct.
Does anyone want to move that we not make an ADC contribution?
I move that we don't make the ADC contribution of 120,525.
Second?
I'll second it.
Do you take a roll call or?
Yes. Member Sleeth,
I agree.
Chair Hill,
Aye.
Member Jane,
Aye.
and Member Brickley.
Aye.
Okay, that's for the ADC. And then for motion of maintaining the current strategy, moderate index plus passive strategy, motion to maintain that strategy.
Can I move? Yes. I move that we maintain that strategy, moderate strategy.
Second it.
Okay. And do a roll call. Chair Hill,
Aye.
Member Brickley,
Aye.
Member Sleeth,
Aye.
and Member Jane.
Aye.
Do we have the power to do this outside of the council itself?
It's a recommendation.
It's a recommendation.
Recommendation, that's all it is, okay.
So is that it, Tanner? Thank you.
Yes.
Thank you.
Thank you, Tanner. We
Thank you for
appreciate
coming
it.
in person.
Thanks for all you do. Thanks, Angela, for keeping us going. We both, and we appreciate it. Thank you so much.
Thank you for your time.
Thank you.
Okay, the next item on the agenda is to set the meeting dates for this fiscal year. It's been the second Tuesday of every month at 2. I think there's a calendar provided in our meeting packet. So how do we do this?
Yes.
Robert, do we?
Oh, thank you, Chair Hill. Yeah, this is just to establish our meeting schedule for fiscal year 25-26. We do this every year just to establish a regular meeting schedule for the committee. We meet every Tuesday of the month, and in your staff report, I've listed the potential meeting dates based off of our regular meetings for the 25-26 fiscal year. And also included the calendar for 25 and the calendar for 2026 for the committee to review. Wanted to also mention that there is some study sessions with the city council on the budget. They're listed in the staff report as Wednesday, April 1, Wednesday, May 6, and Wednesday, June 3rd, and all in 2026. In reviewing this, I just noticed that November 11th is a Tuesday, and it is also Veterans Day. So town is closed. I mean,
Okay.
I'll be here if you want me to meet here. Well, we can hang out. But it's a holiday, and I just noticed that, and just wanted to kind of maybe make a suggestion for that Tuesday, November 11th meeting. We can move it to either Thursday, November 13th, or the following Tuesday, November 18th. For a regular meeting.
Anybody have any preferences? I don't.
I don't.
Anyone?
I'd move that we move it to the next Tuesday. which is the 18th of November, and that we accept all the rest of the dates has been set up.
I'll second that.
Okay, second. Jane, okay, roll. So that's for the regular meetings, and then just for the committee, also, just to note the study sessions with the city council for budget study sessions, April 1st, 2026, May 6th, 2026, and June 3rd, 2026. With that, we have the motion and the second, and I will do if there's no other questions, I guess, a roll call. On the meeting dates, everyone's okay with that? Okay, so I'll do a roll call. Chair Hill,
Aye.
Member Sleeth,
Aye.
Member Brickley,
Aye.
and Member Jane.
Aye.
Thank you. So the meeting dates are listed in with the updated Tuesday, November 18th as the regular meeting, substituting November 11th. So apologies on the oversight on that one, but I'm glad I saw it.
And the last item is Robert's going to give us an update on the ADP contribution that was made at the end of June.
Yes, correct. Just wanted to update the committee that, let's see if you can see it. It's on my report, and I'm going to hand this out. Take one. Yes, as you are aware, we made the 3 million ADP payment in June of 2025. And so just real quick, the projection of the savings, as we presented in our meetings, in the previous meetings in March and May, was 1.257 million over 5 years. With this payment, the savings is 1.24 million, so there's a difference of $17,000. The projected overall over full amortization was 5,427,000. The updated is 5,353,000, a difference of 73,000. So the ad hoc committee and staff, what was presented was fairly accurate and very close to the savings. I was just providing this to let you know we made that ADP payment June 20th. So I think that was just the adjustment. So it hit CalPERS by June 23rd. So made the payment. Also just wanted to highlight in here what that does to our UIL. So our UIL is now going to be 961,000 for 25-26. That's a difference of savings of 234,000. As you can see in that column, there's the savings. And then you can see the expected UIL payments from fiscal year 26-27 through 29-30. You can see starting 26-27, we have a savings of 241,000, followed by 247, 254, 261, and that comes out to the 1.24 million that you see over the 5 years of the UAL.
We'll spend that on parking spaces.
Yes.
You're going to spend that on what?
Parking spaces.
Yeah, that's true.
So that savings, correct. We've made savings and again,
Robert, did you deal with Julian Robertson on this?
yes.
And did he indicate if or how, and if so, how, are we going to be allocated any of the gain or loss from the last 10 days of the fiscal year?
I believe, yeah, we won't know that. The good question, because of when we made the payment, we made it post-April. It won't be updated in our current actuarials that are coming out at the end of August. So the 2024 CalPERS actuarial won't reflect this, won't be in that actuarial, but it reflected in our current UIL payment for this coming fiscal year and then the projected going forward. Yeah, the timing of it is, I would assume that the last 10 days, 7 days would probably be allocated to us.
Okay.
But without, I just wanted to provide this update to the committee. And again, thank you to the ad hoc committee and, our budget meetings and presentations to the council. We made this ADP, and you can see the overall savings that we'll experience. And as George mentioned, we'll spend it on parking. That's all I have.
People are looking a little.
I'm just kidding.
We
I had other
really-
things.
So Stephen and Wallace and Thomas, we're having parking issues with the popularity of the town center
Right.
and of the library, because people can't find spaces here on site, and they're parking on Maple and Walnut and the residential streets over there. So we're, pulling out all the stops, being very creative and trying to find little spaces that we can fit here and there and everywhere. And the city manager is going to expound a little bit more.
We'll be doing some restriping of the spaces along the Caltrain corridor. We'll be adding some parking spaces along the west side of City Hall here in the greenery area. We'll be doing a total town center circulation study, and we'll be implementing a permit parking system, resident-only permit parking system on Ashfield and Maple. So
Uh-huh.
spending some money on these things.
It's a problem when your neighborhood gets impacted.
Yeah.
with that.
Wish we'd done that.
People
Yeah,
just
up on
parking
Selby, we get all the
willy-nilly.
coming.
Do I ask, does anyone have any future agenda topics?
We do
I'll
have,
have one more
we,
question. Can
we
I
also
ask
do have
without
one member
anybody-
of the
Sure.
public online
Go
who
ahead.
does have a comment. Yeah, Anne online has a comment. Let me just.
Okay, can you hear me?
Yes.
Oh, great. Yeah, hi, this is Anna Von Walker. I'm the immediate past chair of the Audit and Finance Committee. I just wanted to, first of all, welcome our two new members. Really glad to see that Steve Brickley and Suzanne Jane are jumping right into the fray. So thank you very much for joining the committee. And congratulations to Tom Hill as your new chair, and to Pete Skolnick as the vice chair. I'm sure they're going to do a fantastic job. And then finally, a big shout out to our subcommittee of Tom Hill and Bob Polito, also a former chair of this committee, for all of the hard work that they did on pouring through all the CalPERS stuff and trying to figure out what it meant and trying to get CalPERS to explain what it meant. And I'm very pleased that, we've all learned a lot more about it. We don't like it so much, but we've learned a lot more about it. And with the committee was successful in convincing essentially the council that it did make sense to make an additional discretionary payment. So thank you to all those people who were involved on that. Thank you.
And we all
Thank
need to
you.
thank you for your several years of being the chair. Thank you so much. You did an excellent job.
You're quite welcome. Thank you, Wally.
Thank you, Ann.
Thank you.
I have a question. It's actually for Elizabeth and maybe for everybody, but I noticed that what happens is the agenda is given to us. So here's the things that you need to take a look at. So I don't want to step outside of my bounds. Is that the way it works? Is the council says, these are the items that I want you to take a look at, so look at those. So if I have an interest in other things, because I think audit and finance is a little more expansive than that, that's your interest, Steve. Here's the things you need to look at. Is that kind of how it works? And it's worked really well?
I'm going to speak off the top of my head. I think that a conversation with the, I think if you have an item that's not, that has percolated up with you, you should talk to the finance director. And he has open door policy, and you can talk to him because he and the city manager set the agendas on a timely basis on what needs to be addressed at a certain time, date and time.
So I can maybe expand on that a little more as well, Steve. So Robert is supposed to meet with the chair in advance of each meeting and kind of go through the agenda. And there's certain routine items that come up for the finance committee that will make sure show up on your agenda. But there's also a charter for the subcommittee that says, hey, these are the things that the finance committee, these are your parameters, so to speak, your box that you work within. If there's something outside that box or something in that box that you really haven't talked about, that you want to talk about, feel free to talk to Robert or myself and
I
we
just need to
can,
know what the box is.
Yeah.
Oh.
So I could read that on
Sure.
the
Sure.
charter.
we'll make sure you get that.
There usually is a new committee member protocol or training, and that you're given all this.
I'm not
information.
trainable.
Well, I can see that. However, we
Sorry.
present it to you and Suzanne, and, you know, as something that you need.
So it's like 5 bullet points. I can read those if you like. They're short.
Sure.
Sure, it's on the town's website under the Finance Committee, and it's act in an advisory capacity and make recommendations to the city council upon request in all matters pertaining to town finances. And that's pretty broad, but it's city council upon
Yeah,
request. and that's
the
the-
key words there, advisory. It's,
Yeah, and
it's,
that's
hey,
the-
Steve, don't do this.
Yeah, and that's the top-down part of it that
Okay.
you were talking about. Consult with the city manager on matters pertaining to the budget, capital spending plan, and long-range financial plan for the town. So
Same
any
thing,
members-
same thing, right?
Yeah.
You say, I need help, and take a look, and, okay.
Act in an advisory capacity and make recommendations to the council upon request in all matters pertaining to the town's audit. And that comes through the Finance Committee and percolates up to the city council.
Okay.
Provide oversight of the annual audit and present and explain the audit to the city council with recommendations as to acceptance. And again, that's percolates upwards. Advise the council regarding appointment of outside auditors for the annual audit. We bring the annual auditor contract, or not annual, triannual audit contract through the Finance Committee. And then review the proposed audit scope with outside auditors prior to commencement of the annual audit. That's the interest of things. But if there's anything outside that box, feel free to reach out.
Yeah, I just see, Bob moves in such, everybody does, in such liquid format amongst, he just seems to move within and out the budgets and numbers, and I wonder, do I need, anyway.
Well, the OPEB thing is outside of those bullet points. And so
Yeah.
that's one of the things that came out through the Finance Committee. We should look at this and.
Yeah.
And I'm going to, we talk about the CalPERS report, so we're going to bring the CalPERS actuarial report for 2024 at our next meeting. And then the OPEB, we're going to do there's a new refresh. And because we had Andrew here during that new refresh, we'll have the updated numbers, as Andrew had mentioned, for as of June. But yeah, we'll present those. And those are, items that we continue to focus on.
Another thing that came before the Finance Committee that was kind of outside that realm, but was top down, was when the town was considering certificates of participation for the town center project. The Finance Committee participated in
Okay, if I
We're
could,
still working on CalPERS stuff. We're not done with those.
we will be forever.
Yeah, we are.
Could I just say one thing I wanted to point out to the new members, and that is during my term as chair, one of the things that I added to our standard agenda is future agenda topics. That was my attempt to provide a forum where those of you who are on the committee could say, gosh, shouldn't we be looking at X, Y, Z? And of course, because of the Brown Act, we can't just take it up right then and there, but we can present it to the town manager and to Robert, and then they will, if they think it's appropriate, put it on an agenda for us to, and we've taken advantage of that several times. And, obviously we don't want to go outside of our bounds, but I think that we actually added some value to some things that we said we should look at this. So don't be shy to suggest future agenda items.
Thank you.
Anything further?
I move we adjourn.
I second.
Wait.
Yeah. I need a
Oh,
gavel.
it's right here. Sorry.
Okay, we're adjourned.
Sorry.
Thanks,
Thank
Suzanne.
you.
Thanks, Ann.
Thank
Thank you, Ann.
you.